financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Welcome to Financial Fitness. I'm Jess Tyler along with the Money Doctor, Dr. Francis Rayam. Hi.
Good morning, Jess. How are you?
I'm good. So we get to actually see each other, which is lovely. Today we are talking about a topic which is really funny because I just heard a funny commercial about it, and it's life insurance.
Oh, really? What, you heard a funny commercial about life insurance? Do tell.
I didn't know how it would work, but it was this commercial that came on that basically said, like, if you're overweight and don't take care of yourself and you're, one step away, call Big Dave because we'll insure even you. And I just thought, is this working? But it must be because they're advertising.
Well, Big Dave might know a little something about that, actually.
It's basically the people that don't want to have to pass like the doctor's requirement part of it, right?
Yeah. So, I mean, that's a kind of it is a funny commercial, but it's meant to be disarming, I'm sure. And it does speak about a very specific kind of life insurance. And so we're going to go over today the different kinds of life insurance, the reasons you might have it, try to sort out some of this mystery about some of the things that are less known than others, and give you some idea about why you might need or not need life insurance, how you figure that out, and what kind would be best for you to get so that you don't fall prey to, well, a big day,
Big Dave.
a big day.
I'm also curious if we have time to touch on whether there's ever a time that what you get from your employee, when you can times your salary, is that ever enough? So I'm
Oh,
curious
from your
about that
employer?
too. Mhm.
Yeah, from your employer. Yeah, it might be, but okay, so let's start there and we'll talk about Big Dave too, and then we'll go on to other things because I feel like I'm picking on poor Dave, and there's a place for what Dave is saying to do. So, okay. So what you get from your employer, let's say it's 3 times your salary. Is it enough? Maybe, and maybe while you're still working, what you need to understand is what happens to it when you leave work. Do you get to keep a reduced amount? Like, let's say you have $150,000 of coverage while you're working. If you leave, does your employer say you get to keep a $5,000, say, paid up policy, or you get to pay the premiums on it and keep it? So
Mhm.
they can say anything they want about it, basically. It's one of your benefits. You might want to ask your HR people, what happens to my life insurance when I leave? So that you know,
Mhm.
because one of the biggest things about life insurance is, and everybody will tell you this, if you buy it when you're young and healthy, it will be cheaper.
Mhm.
The, the rub is that when you're young and healthy, you often can't afford much life insurance.
Or you're not
Um,
really thinking about it. You think you're going to be young and healthy forever.
yeah, it's true. But okay, so let's talk about Big Dave for a minute.
Okay.
What he's talking about, I'm assuming, and I've not heard the ad, but I'm assuming that he's talking about something we call guaranteed issue life insurance. So just to give you a rough overview, there's so many different kinds of life insurance. There's whole life, there's variable life, there's universal life, there's variable universal life, there's term
Mhm.
insurance.
It gets confusing.
Yeah, it gets confusing. And most people don't start by saying, what kind of life insurance do I need? They start by
Mhm.
saying, how much life insurance do I need? And then the usual comment is, I'll just get term because it's cheaper.
Mhm.
Or, no, I want permanent insurance because I don't want it to end.
Can you explain the difference between term and permanent or term and life?
Absolutely. Term and permanent life insurance. Okay, so term insurance is just what it sounds like. It's there for a certain term, right?
Okay.
It might be 10-year term, 15-year term, 20-year term, 30-year term. But at
So
the
not to be that basically means you have to die within that time period.
wow,
Not to
that's a
put it too
little harsh.
bluntly. Little hard.
That's
I
a little
didn't pretty
harsh,
that up at
Jess.
all. I know. But that's
I don't think
basically what it means, right?
I don't think anybody would buy a policy that says they have to die within the term.
If you don't die within this 10 years, you're getting nothing.
But that's kind of how it works, actually. If you don't die within that period of time, the premiums you've paid are
Mhm.
gone, right? They've been paying for death benefit only, no cash value, and the policy ends. Okay, so that's term insurance. Now, we're going to
Okay.
talk a little bit about how term can benefit you in a number of ways, but that's how term insurance works versus some sort of permanent insurance like any kind of whole life, variable life, universal life, variable universal life, those things that build cash value in some way. That's the
Okay.
basic difference. If you don't know if you have term or you have some whole life product and you can't find the words on your statement, do you build cash value or do you not?
Hmm.
Now, the gray area, there's always a gray area. You might have something like, say, a universal life policy built on a term chassis. So you might be paying for permanent insurance, but as cheaply as you can.
Hmm.
But it's still permanent. It's just not building any or much cash value. So
Okay.
it is, it's a hot mess, right? Insurance is a
For
hot mess,
sure.
but there are ways to sort through it. So that's the difference between term and permanent insurance. And permanent insurance, we would call some form of whole life contract. As I said,
Okay.
universal life, variable life, any of those are under the permanent insurance umbrella. And
And the
term
whole life
insurance,
is obviously going to be more expensive.
yes, it is going to be more expensive. And depending on the kind of whole life you buy, it will cost you more in premiums than some
Okay.
others. For instance, a universal life policy may be less expensive than what we call a plain vanilla whole life policy. The question isn't always one of expense, though. The question is often one of value.
Hmm.
How expensive was your term policy if you paid for it for 25 years and didn't use it?
Hmm. Yeah.
It did cover your death benefit, and that's what you wanted it to do. But now you're 25 years older, you may not be in good health, and you might be in the market for insurance again, and now you're going to really pay for it.
Hmm.
Whereas some whole life types of policies, universal life is a good example, where you might be able to pay for it for a period of time, it builds up enough cash value to start paying for itself, and it's
Hmm.
still permanent insurance. It's not that one of these is better than the other, it's that you have to find the right fit for you.
Is there
So,
a time that you would recommend someone get either a term or a whole life insurance policy? Is there a certain age or other factors?
well, if you're going to die, I think it's a good idea to have some life insurance.
But I
But
mean, would you take it out when you're 30 or would you take it out when you're 60?
yeah, clearly taking it out when you're younger helps. But life changes. You might need a lot more insurance when you're 30 and you have 3 small children at home and not a
Mhm.
lot of assets and a wife or a husband that maybe can't support themselves without your income.
Mhm.
Hello, that's a cause for life insurance, right?
Yeah.
You might take it out if you have a business partner who can't run the business successfully if you die without some real capital. So you might take out life insurance and make the business partner the beneficiary on it. So if something happens to you, the business can continue to run,
Okay.
thereby perhaps supporting your family.
Mhm.
Some people will buy it to build cash value, tax free. If they buy a whole life policy and it's funded a specific way, and it doesn't breach some guidelines, which
Mhm.
upfront, then you might build cash value in there tax free. That I could go on for about an hour about, but I won't. I'll just say if someone is selling you a policy telling you you're going to be able to take that cash out tax free in the future, in my opinion, it better be a big policy. It better be big enough to make that worthwhile. Because when you get these really large policies, 10, 15, 20, $30,000 a month going into a policy like that, you can
Mhm.
build a pile of money that you can take out tax-free in the future. And that
Do
might
you
be
get
part of,
taxed on it when you take it out or no?
not if you take it out by loaning it against the policy, which is why I say the policy has to be so large. Because if
Okay.
you still want some death benefit, you want to be able to borrow some money against the policy and still keep your death benefit. When you take money out of your whole life type out of
Mhm.
your permanent life insurance policy, how do you do it? Some people will cash it in. They get a policy, it's got some cash value in it. They see the cash value and they don't think they need the death benefit. So they cash it in and they take the money.
Mhm.
That becomes taxable.
Okay.
That's then a taxable event. Now, I have to say, of course, my disclaimer, I'm not an accountant, right?
Mhm.
But that becomes taxable. If you borrow the money against your own death benefit, it's a tax-free transaction as long as you didn't breach that MECA guideline we're talking about. Let's say you have a $5 million policy and it's
Mhm.
built up, I don't know, $300,000 of capital. These are ridiculous numbers, but let's just use them.
Mhm.
If you take out, 200,000 as a loan against the policy, you don't have to pay it back. You're borrowing your own death benefit. It will accrue interest. So the loan will continue to grow against your death benefit. But if you
Mhm.
die, they just subtract it from the death benefit.
I'm assuming that you would recommend then always borrowing against and not taking it out and getting that big tax penalty.
Usually, yes. I mean,
Okay.
there are
Yeah.
times that it makes sense. I've seen people who have built up more cash value than their death benefit is. You know, it's
Oh.
an old policy that a parent bought for them when they were a child or something. They've built up, $15,000 of cash value and they only have $5,000 death benefit. I mean, it's tricky. What you need to do is find an insurance agent that you can trust who's speaking to you and helping you sort these things out in some way that makes sense. I mean, us trying to go through, a life insurance tutorial in half an hour is tricky at best and certainly
Mhm.
not, conclusive. So yeah, I said I wanted to talk about Big Dave for a minute.
Okay.
So Big Dave is talking, I think, about another kind of life insurance, which is called guaranteed issue or
Okay.
guarantee issue, depending on who you speak with. Guaranteed issue is something you see it from AARP and some other companies. Sometimes you'll get a flyer in the mail that says no exam necessary, answer
Mhm.
3 medical questions or no questions, no exam necessary. And there's always some tricky phrase like your premiums will never go up
Mhm.
or your death benefit can never go down, right?
Yeah.
Usually what the way these things happen is, yes, they will issue them on a guaranteed basis. For instance, I've seen people who have somebody in their family who is terminally ill. They know it. There's no money to pay for a funeral, and the person's been given 2 years to live,
Mhm.
right? Well, they might roll the dice and say, we're going to take out a guaranteed issue product because they're not going to get issued, any other kind of insurance. And we're going to make these premium payments hoping, of course, that their loved one lives longer than the entry period, which is usually 2 or 3 years.
Mhm.
And so the way it works is something like this, usually. You're going to pay in your premiums. If the person dies after, say, the 3-year mark, you're going to
Mhm.
get the whole death benefit. So let's say you're buying a $10,000 policy and you're paying in, $200 a month or whatever the premium is. If they die after the 3-year mark, they've basically made the grade, and you're gonna get paid the full death benefit. If they die prior to the 3-year mark, you will usually, I know AARP had a product like this, I don't know if they still do, but you would get all your premiums back that you paid, plus some interest, and they had a pretty good thing. It was like if they died in the 2nd year, don't quote me on this, but it was something like you got 25% more than your money back or whatever. So you get a
Mhm.
reduced death benefit, but it still might be worth doing because
Okay.
you're going to get all your premiums back anyway if you take that kind of policy. But read the small print because it may not be that way. I mean, I remember that as being one of the better guaranteed issue policies you could buy. But that's, I
Mhm.
think, what Big Dave's talking about. And it isn't that people don't want to go through the physicals, although I'm sure, people get frightened about that, but it's pretty minimal what they'll do. They'll usually send a paramed to your house. They'll ask you some questions by phone.
Mhm.
They'll get your doctor's records if they need to. But if you're in that situation, maybe not even terminally ill, but just let's say you have a heart problem. Okay, well, you might go for traditional insurance and you might get what we call rated. In other words, you might get a higher premium because you're seen as a higher risk, or you
Mhm.
might get declined. If you're declined, you might be calling Big Dave, all right? Or preferably searching the market for the best terms you can get on a guaranteed issue contract.
Okay, I have another question on this, which we will get to in the second half, but first I do wanna get your phone number,
Absolutely, Jess. It's 413-773-3333.
and you can go to hugyourmoney.com as well. We'll be right back with the second half of Financial Fitness with the Money Doctor, Dr. Francis Ram. It's coming up on WHMP. Welcome back to Financial Fitness. I'm Jess Tyler along with the Money Doctor, Dr. Francis Ram. Hi, I'm always happy when you're still there. I had a
Yeah.
question that I wanted to ask you kind of about Big Dave. So when you're laying in bed at 2 in the morning and can't sleep and you see those infomercials that are kind of the same thing as Big Dave, where it's like, call now, we're going to guarantee this. It's $5 a month and you can get however much. How do you know if it's a scam or not? Because a lot of those just seem way too good to be true.
Well, they may not be a scam. Like for instance, Big Dave, who we're giving a lot of free advertising to, and I have no idea whether Big Dave's product is any good or not. So please, know that we're using him as an example here because you had seen that commercial. Um, it's not necessarily that they're a scam, but they may not be the best deal for you. And that's where I would
Okay.
go to somebody that has some real clout and something to lose, like an AARP who has such a big volume of people that they go and they get really good rates from someone,
Mhm.
from a company. I think I remember that contract I was talking to you about was underwritten by New York Life, but it was special terms for AARP. They were
Okay.
competitive terms to New York Life's own policy because they're so big, they can flex their muscle and
Mhm.
they can get something like that done. So when you're looking for something like that, you certainly can go to an independent broker. You could call somebody like us or any independent broker and say, I'm looking for some life insurance. Here's my situation. What do you think would work for me? And get some quotes. There are some companies that you can call and just, pretty much any company that you can call and get quotes from. I
Mhm.
would say it's been my experience. It's not necessarily always true, but when you get the flyer in the mail that says, just check this box and pay this much and there's no premiums or anything due, maybe go shopping. It's,
Yeah.
that's a little too easy for me to just say, yeah, tick the box and pay the money.
So I was
Yeah.
gonna say, if you're listening to this show right now and you don't have life insurance and you're thinking about getting it, what are the first steps? What are the first things you would look for? Obviously, I think you said, call a broker.
Yeah, I think so. But before you do that, I think start to think about why you need life insurance, if you need life insurance, and what it does for you. So here's some examples.
Okay.
Let's say, as I said earlier, maybe you're a person with a family, and if you pass away, they cannot make ends meet without you,
Mhm.
right? Okay, that's a reason to put some life insurance on yourself. Now, people will say, well, it's expensive. I don't want to pay those premiums. Think about it this way. If you were paying $100 a month for a premium, I forget whether it's affordable for you or not, just for this exercise. But let's say you're paying $100 a month for a premium and you're buying a $100,000 term policy. How
Mhm.
long would you have to shell out $100 a month to lose the game? I mean, you're leveraging your money by so much when you buy life insurance. You pay
Mhm.
$100 and you die tomorrow, they pay 100,000. That's the
Right.
life insurance game. You're probably never going to pay in $100,000 in premiums at $100 a month, right, to cover that death benefit. So that's the idea, is that you can use your money to leverage it. So that's one example of when you might need life insurance. Another is, let's suppose you have 3 kids at home and
Mhm.
your spouse could do okay, but the kids can't get through college without that money. Here's a very simple one. You have plenty of money. You don't care. Your spouse is going to be fine.
Mhm.
Really want to spend down those assets, for your burial and for other things? Or do you just want to leverage your money and spend a few dollars and buy some life insurance? They're going to get the proceeds. Beneficiaries get life insurance proceeds tax free. So, you might, let's say you're a multimillionaire. So pick up a few million of life insurance for next to nothing. It doesn't cost
Mhm.
you much to do it. And if you die, that money is available tax free instead of them having to liquidate assets to do things like pay a mortgage on your home until it gets through probate, or on your
Mhm.
investment properties or something like that. Uh, we talked about a key man policy or a buyout policy for a partner. You might need life insurance for that. When do you not need life insurance? Well, if you're not concerned about your burial costs at all, some people prepay their burial costs and
Mhm.
they simply don't care. They don't have assets to protect. They don't have any debt,
Mhm.
right? Their spouse is going to be okay. They don't have children going through college. Uh, I hate to say it, but I'm an example of this, right? I'm a single person with no children, no worry, I can pay for whatever I want, right? But I have life insurance, and I
Mhm.
have life insurance because it leverages my money. Why would I not spend a pittance, relatively speaking, and leave somebody a lot of life insurance? And in my case, it's family members and charity, right?
Mhm.
So you might not need life insurance, but you might want life insurance. I can fund a school or a project about Bengals or whatever I want to fund with my life insurance when I die for almost no money, and they're going to get it tax free.
Mhm. Which is
So
smart.
yeah, so to simplify that, I think you need life insurance first to cover your burial costs, second to cover any income that might be needed, third to protect your assets and send your kids to college, right? But that's income related. And fourth is just because you want to. You want to give back to somebody, and rather
Mhm.
than leaving them all your assets, you leave them a life insurance policy. It's a great way to give to charity, for one thing. Yeah.
Mhm. So if your spouse comes to you and says they want to take out a $5 million policy on you, at what point should you go to the police? I feel like this is how every Dateline starts.
I don't know that you go to the police. I mean, I have a couple that came to mind immediately when you said that, because he did call me and say, it was 10 million, but I want a $10 million policy on my
You
wife.
and Keith Morrison are going to be sitting down together very soon. I'm just letting
Oh
you
my
know
gosh.
now.
Well, I hope not, because I have her on video saying, yes, I want it. And then she said, but I want a $10 million policy on him.
Hmm.
And so that was reasonable. And we actually talked about it, and it turned out that they didn't quite need that. I think we did 8.5 on each of them or whatever, but whatever it was, we found something within their price range that covered them both. And we talked about all those reasons that they have to have it or want it. And again, for them, it was largely about protecting a business, protecting assets, making sure their kids were okay when they were gone. What if their kids ran the business into the ground? Can they still survive?
Yeah.
The real kinds of life things that people think about. Um, I want to talk about term insurance before we end this, though, because it gets a bit of a bad rap sometimes, or too
Hmm.
good of a rap, depending on who you speak with, because people say, well, term insurance, it's cheap, it covers my death benefit, it's great, and I'm not going to need it when I'm older because I'll have
Hmm.
plenty of money.
Okay. We
It
hope.
might be true, but what
Right.
happens if you do need it? And
Hmm.
here's the thing. We talked about guaranteed issue, because I don't think people really know the nuts and bolts of it. And for term insurance, I want to bring up this topic, because this is maybe the most important reason to pick up term insurance when you can't afford or don't want a more expensive policy.
Okay.
Most term insurance is what we call guaranteed renewable or guaranteed convertible. And what that
Okay.
means is that when you're young and healthy and you can afford the $25 a month premium to buy your $250,000 policy,
Hmm.
you are protecting yourself in the future, yourself, not your family. I mean, you are protecting your family, but you're protecting yourself in the future in case you become uninsurable or rateable. In other words, let's suppose you're young and healthy now, you pick up $25 a month and you pay the term. And
Hmm.
let's say it's a 30-year term policy.
Okay.
And you're 25 years old. By the time you're 55 years old, you might have some health problems. You
Hmm.
might have diabetes, for instance. It doesn't have to be some terminal disease, right? Maybe you just have AFib, okay? But that might mean that you may not be eligible for a reasonably priced, or eligible at all, for a whole life policy or even another term policy.
Hmm.
However, the term policy you have is probably guaranteed convertible, which means that they will have to, even if you're terminally ill, they have to convert that insurance if you ask them to, some or all of it, you get to choose,
Hmm.
to some form of permanent insurance. And you're going to get it based on your healthy rate you bought it at when you were
Mm.
25. So
So
if
that's
you
kind of a benefit to buying early.
It is, because if you got, let's say, a preferred non-smoker rate, you're out there running marathons, and you don't have to be that. You just have to be in good health and
Hmm.
non-smoking. But if you get preferred non-smoker rates, you're going to get a very inexpensive premium. Get to age 55 or 60 or 65, and now you maybe have some health problems, you're still going to get a preferred non-smoker rate, but you will have to pay for it at your current age. Still,
Hmm.
it's a great deal if you want to convert some of it. And what some people do is they pick up, $500,000 term when they're young, and by the time they're getting to retirement, they're looking at, okay, my term policy is going to end, maybe I should convert some of it. Maybe they convert 50,000 to permanent
Hmm.
insurance and they let the rest of it go or whatever. Or they do some sort of term and whole life blend. But it's really worth it for people with a term policy. Anybody listening to this who has a term policy, who is just living under the idea that my term policy will end and then what? You should
Hmm.
check to see if it's guaranteed convertible, and maybe get some quotes from your broker. Hey, what would it cost me to convert 25,000 of this? 50,000, 10,000. What can I do? Find out what
Hmm.
your options are while you have that term insurance in place. Don't just let it end without knowing what it does. That's perhaps the most under exercised value point I could give you today, is to check on your term insurance and see if you want to start converting pieces of it. You could even convert, I want to convert 25,000 this year. I'm going to
Hmm.
convert another 25,000 next year. Things like that. And your broker should be able to help you do that.
Quick question about back to what we talked about in the beginning with the employee that usually offers you, if you want to do 1, 2, 3 times your salary for insurance. If you have a separate whole life insurance, do you need to do that? I mean, it seems like with the employee, it's really cheap to be able to do that. Is it smart to just do that in addition?
Yeah, I think for the money they charge you, I mean, it was $7 a paycheck or
Right.
something to get 3 times your salary. I think it is a really good idea to do that. You do, however, want to check with your HR people and see if your employer is offering you accidental death benefit
Hmm.
or real life insurance. I mean, I've seen some people, believe it or not, paying a premium that they thought and it looked like it was high enough to be real life insurance, and really it was for an accidental policy. It only paid if they were in an accident or if they lost one limb or one eye or one
Hmm.
hand, and they were paying
Okay.
these premiums for something that may or may not ever happen, which is fine if they're really cheap premiums. You see that ADD on your,
Right.
it's $1.15 or whatever. That might be worth it. But just know what you got. I mean, that's the whole deal is ask your broker, ask your HR person, have some independent person take a look at it and help you sort through it. But know what you have and really, it can be such a tool for people. I mean, we don't talk about it very often because it sort of is one of those, I don't know, it's sort of sort of one of those background things. People go, "Yeah, and I have some life insurance." And
Hmm.
then I say, "Do you know if it's whole life or term?" I don't know. Does it build any cash value? I don't know. I think so. How much is
Yeah.
it? I'll say, "How much is the cash value?" They'll say $200,000. I say, "That's the cash value?" I don't know, that's what they pay when I die. That's your death benefit, right? So we just don't talk about it. Nobody wants to talk about dying. And nobody certainly wants to talk about
Hmm.
buying a policy that they must die within the term of, Jess.
Right. I don't think they're hiring me for the advertising campaign for that.
I don't know. I
If
think
you think you're going to kick off within 10 years, we'll pay you.
I love that you say things like that because I think it's what we all think, is
Just don't say.
I'm sending this money out. What good is it to me? I'm going to be dead. But there
Yeah.
are features that you can access when you're alive, especially in some form of permanent insurance. But yeah, just know what you've got. Use it to protect your assets. Use it as an estate planning tool. And people say, well, I'm going to leave my house to my son or daughter. Now, if you leave it to your spouse, it's not such a big deal. But you're leaving it to a child. If you haven't done a life estate, a legal document to do that, then
Hmm.
they're inheriting your house. Well, that's fine, but now your will is in probate, maybe for 6 months, maybe for longer. Just because you have a will doesn't mean they get the money immediately. It has to go through probate court. If
Right. And
your
are they
house
going to
has
have the money to run that?
yeah, a
Yeah.
mortgage, repairs, whatever, and the life insurance, they'd have it in a week, 10 days in their hand,
Hmm.
tax free.
All right. Well,
Yep,
let's get your phone number. There's a lot to this. So let's get your phone number if people have questions.
sure. It's 413-773-3333.
All right, perfect. You can also go to hugyourmoney.com. We'll be back next week with another episode of the Financial Fitness with the Money Doctor, Dr. Francis Ram, right here on WHMP. Thank you.
Thank you, Jess.